So let's talk about how this actually works. Because when people hear AI investing, they usually picture something mysterious or overcomplicated, and it's not. I want you to think about this differently. Ask yourself one question. What would your ideal portfolio look like if there were no limits? Not the one you hope works, the one that's actually engineered to win. For me, the answer is obvious. I would want a portfolio built from the most productive holdings possible. Stocks and ETFs that grow faster than the market, and at the same time, throw off real cash along the way. And I'd want AI scouring the entire market, constantly, looking for the best of the best, companies with real revenue growth, rising profits, strong cash flow, operating in the parts of the economy where momentum and excitement actually exist. And not just fundamentals, I want AI watching the technicals, the trends, the sentiment, making sure every position is set up for success. Then I'd want all of that turned into a concentrated portfolio that's also diversified. It would be less than 20 positions, focused and intentional, roughly split in half. One side built for income, with the most stable, high-yield ETFs available, the kind that have a long track record of paying out weekly and monthly cash dividends. The other side built for growth, selecting stocks in strong, sustainable trends, entered at moments where the odds strongly favor a 30 to 60-day upside move. Now here's where it gets powerful. Those income positions, they start paying you almost immediately. That's cash hitting your account every week, every month. At the same time, the growth positions are doing what they're designed to do, capturing gains, and those gains compound into the next opportunity as positions are bought and sold, and the account keeps getting bigger. Income feeding growth, growth accelerating income. And while all of this is happening, AI is running quietly in the background, monitoring every position, measuring performance against expectations, and making course corrections when conditions change. AI is amazing when used this way. AI can look at hundreds of data points per position and across the entire market every single day. No human can do that. No discipline can replicate that. And when markets get rough, because they always do, AI doesn't panic. That's where Treasury ETFs would come in. They reduce risk, they preserve gains, and they still generate good income. They act as a parking place when there's nothing worth rushing into, so you're not giving back gains just to stay busy, especially in down markets. And all of that, just as I've explained, is StockPilot. Here's the part people love. After you subscribe, you decide how much money to commit to your dedicated brokerage account. That's it. On the next market day, you buy the income positions that StockPilot already holds. About half your capital goes to work immediately, and within days, cash starts flowing back into your account. Then you build the growth side one trade at a time. Alerts come in after the market has already closed, around 7 p.m. Eastern, in the app, by text and by email. They tell you exactly what to buy and exactly how much. Usually there's only 1 or 2 alerts per week. That's it. You enter the trade, set it as a market on open order, and it automatically executes the next morning while you're already going about your day. No screens, no stress, no guessing. And the process is so simple. Commit the capital, buy the income positions, start getting paid, add growth positions as alerts arrive. And before you know it, you're sitting on a balanced, high-yielding, growth-driven portfolio that only AI could realistically build and maintain day after day. You cannot mess this up. It doesn't hijack your time, and it doesn't rely on emotion. You just follow along, collect the income, and let the gains compound. Honestly, what could be better than that?